As players in the game of real estate, we've all been conditioned and trained to watch for the constant movement of the cycle. Real estate has forever operated in a cyclical fashion, and conventional wisdom would suggest that it forever will. But as we move past the 10th year of this current cycle, we're challenging that long-held notion. It's difficult to find any ominous clouds on the horizon. Supply levels are in check, thanks in large part to continued upward pressure on costs. Absorption levels are down from prior periods, perhaps, but not dramatically. We can't even measure future resident demand when you begin to include the 55 and older population that will become increasingly interested in renting. And perhaps most importantly, because of the favorable fundamentals, the capital flows into the apartment space are at historic levels. Capital flows, including specifically new capital to secondary central U.S. markets like Indianapolis and Louisville, for instance, far outstrips available product in the market. This imbalance has created a situation where there is seemingly no positive correlation between adverse circumstances and investor sentiment. Interest rate volatility doesn't erode asset pricing. Fannie and Freddie temporarily pulling out for the balance of 2019 didn't deter bidder velocity, and adverse asset level events don't soften buyer forecasts. There's not only not been a positive correlation, there's seemingly a negative correlation between these events, which obviously can't occur, but they are happening at the same time and space, which begs the question, where does it all stop? We think the only plausible answer to that question is that it doesn't stop. We've simply entered what is now the new normal in the multifamily transaction space. And it's very encouraging, depending on which side of the table you sit.